In 1991, Kerry Packer sat before the Australian Parliament in a televised inquiry about tax practices. He was one of the richest men in the country, and politicians wanted to know how he paid so little tax relative to his wealth. The exchange became legendary, not because of drama or conflict, but because of clarity. Packer articulated something that most wealthy people understand, but rarely explain publicly: how sophisticated investors think about taxes. His most famous statement was simple: "I'm not evading tax in any way, shape or form. Now, of course, I'm minimising my tax. If anybody in this country doesn't minimise their tax, they want their heads read. I pay whatever tax I'm required to pay under the law, not a penny more, not a penny less." That statement reveals a mindset that separates sophisticated investors from everyone else. It's not about morality, it's not about patriotism, it's not about emotion. It's about understanding the tax system as a set of rules that can be navigated intelligently. Today, I'm going to explain exactly how wealthy investors think about taxes. Not to promote illegal behaviour, not to glorify tax avoidance, but to teach you the framework that institutional investors, family offices, and sophisticated wealth managers use when approaching this topic. This is about understanding incentives, capital allocation, and strategic decision-making, because taxes aren't a moral issue, they're a capital management issue. The fundamental mindset shift. Most people view taxes emotionally. They see it as a civic duty, a moral obligation, or a burden imposed by government. They feel guilt if they try to reduce it. They feel anger if they pay too much. They feel fear if they make a mistake. Wealthy investors view taxes differently. They view it as a cost of doing business, like rent, salaries, or materials. It's an expense that needs to be managed, optimised, and minimised within legal boundaries. This isn't callousness. It's not lack of patriotism. It's simply rational capital allocation. If you have two identical investment opportunities and one results in lower tax liability than the other, you choose the one with lower taxes, not because you're against government, but because you're for efficiency. Packer understood this completely. When Parliament asked him about his tax practices, he didn't apologise. He didn't express regret. He didn't claim to be a victim. He simply stated the obvious. Minimising legal tax obligations is rational behaviour. Consider what he said. If anybody in this country doesn't minimise their tax, they want their heads read. That's not arrogance. That's clarity. He's pointing out that the tax code itself creates incentives for certain behaviours, investment in certain sectors, employment of certain strategies, allocation of capital in certain ways. And if the code incentivises those behaviours, it's irrational not to follow those incentives. The government creates the rules. Sophisticated investors play within those rules. That's the game, and playing it well isn't unethical, it's intelligent. Lesson 1. Tax minimization is capital management. The first principle wealthy investors understand is that legal tax minimization is simply good capital management. It's not about cheating, it's not about hiding. It's about understanding the rules and using them effectively. Think about this logically. If you earn $100,000 and pay $30,000 in taxes, you have $70,000 to invest, spend, or save. If you structure your affairs legally to pay $25,000 in taxes, you have $75,000. That extra $5,000 compounded over decades becomes significant wealth. Now, multiply that by millions or billions. The difference between paying 30% effective tax rate and 25% effective tax rate on $1 billion is $50 million per year. Over a decade, that's $500 million. Over a lifetime, that's generational wealth. Wealthy investors don't ignore this. They can't afford to, because capital has alternative uses. Every dollar paid in tax is a dollar not invested in business growth, not donated to charity, not passed to children, not deployed productively. The question becomes, well, who allocates capital more efficiently? Government or private investors? Sophisticated investors generally believe they allocate capital more efficiently than government. They believe their investment decisions create more jobs, more innovation, more economic growth than government programs. Whether that's true is debatable, but that's their operating assumption. So when they minimise taxes legally, they're not just keeping money for themselves, they're keeping capital under their control because they believe they can deploy it more productively. Packer didn't hide this view. He was explicit about it. He believed his businesses, his investments, his charitable activities were more effective uses of capital than government bureaucracy. You might disagree with that assessment, but you can't deny its internal logic. If you genuinely believe you allocate capital more effectively than government, then minimising taxes becomes not just rational but optimal. This is how institutions think. Pension funds have legal obligations to maximise returns for beneficiaries. That means minimising all costs, including taxes. Family offices managing generational wealth think the same way. Private equity firms, hedge funds, endowments, they all approach taxes as a cost to be managed. The key distinction is legal versus illegal. Tax evasion is illegal. Hiding income, lying on returns, creating fraudulent deductions, that's criminal, and sophisticated investors avoid it completely. The legal risk, reputational risk, and practical risk aren't worth any tax savings. But tax minimisation, tax optimisation, tax efficiency, these are completely legal. Using deductions the code allows, timing income and expenses strategically, choosing investment structures that minimise tax impact, all legal, all rational, all standard practice. Packer made this distinction crystal clear in his testimony. He wasn't evading, he was minimising within the law, using strategies available to anyone who understands the code. Lesson 2, understanding where money goes. The second principle is understanding where tax money actually goes and what it achieves. Most people pay taxes without thinking deeply about what happens to that money. Wealthy investors think about it constantly. Government spending includes defence, infrastructure, education, healthcare, welfare, administration, debt service, and hundreds of other categories. Some of this spending is efficient and necessary. Some is wasteful and counterproductive. Some creates value. Some destroys it. Sophisticated investors make judgments about this. They calculate whether their tax dollars are being used effectively. And often they conclude they're not. Consider infrastructure. Government might spend $1 billion on a bridge. Cost overruns are common. Delays are frequent. Political considerations drive decisions rather than economic efficiency. The bridge might take 10 years to build and cost double the original estimate. A private investor building a similar project would face market discipline. Cost overruns hurt profitability. Delays lose opportunity. Inefficiency gets punished. So private projects tend to be more efficient. Or consider innovation. Government can fund research through grants and programs. But private capital funds most innovation directly through equity investment. Tech companies, biotech firms, renewable energy. These sectors grow primarily through private capital, not government spending. Wealthy investors see this dynamic. They see that private capital allocation often creates more value per dollar than government spending. So keeping capital in private hands through legal tax minimisation seems not just rational but beneficial to society. This doesn't mean government has no role. Defence, justice, basic research, these are public goods that require government funding. But at the margin, wealthy investors believe private capital creates more value. Packer held this view strongly. He built businesses that employed thousands. He invested in media, entertainment, sports, infrastructure. He created economic value that generated taxes indirectly through employee income, corporate profits, and economic activity. From his perspective, keeping capital to invest in business was more productive than sending it to government. The taxes his businesses generated indirectly probably exceeded what he paid personally. So minimising personal tax while maximising business investment was net positive for society. Again, you can debate this logic, but you can't deny its coherence. If private investment creates more jobs and growth than government spending, then tax minimisation isn't selfish, it's economically optimal. This perspective fundamentally changes how you think about taxes. Instead of viewing it as a moral obligation, you view it as an allocation decision. Do I want this capital deployed by government or by private investment? Most people never think about this question. They just pay what they're told. Wealthy investors think about it constantly, and they structure their affairs to maximise private capital allocation within legal limits. Lesson 3, confidence as power. The third principle is more subtle but equally important. Packer's testimony wasn't just about tax strategy, it was about power dynamics, about how confidence and clarity signal strength. Watch what Packer did in that hearing. He didn't apologise, he didn't hedge, he didn't claim complexity or confusion. He stated his position clearly. Minimising tax is rational, legal and correct. Most people, when questioned about taxes by authority figures, become defensive. They apologise, they make excuses, they try to appear humble or contrite. They signal weakness. Packer did the opposite. He stated his position confidently. He defended it logically. He made Parliament justify why legal tax minimisation should be criticised. He shifted the burden of proof. This is a masterclass in power dynamics. When you're clear about your position and confident in its logic, you force critics to engage with your argument rather than your character. You make the conversation about principles, not personalities. Consider his statement again. If anybody in this country doesn't minimise their tax, they want their heads read. That's not defensive, that's assertive. He's saying the irrational position is paying more tax than legally required, not less. He's making Parliament defend why anyone should pay more than the law requires. This rhetorical move is brilliant. Instead of defending wealth or privilege, he's defending rationality. Instead of justifying his behaviour, he's questioning anyone who doesn't do the same. He's gone from defendant to prosecutor. This matters because public perception influences policy. If wealthy people appear ashamed or apologetic about tax minimisation, that empowers politicians to increase taxes and close loopholes. But if they confidently defend legal tax practices as rational and proper, that changes the conversation. Packer's testimony did exactly this. He made it socially acceptable to acknowledge tax minimisation as intelligent strategy rather than shameful behaviour. He normalised what was already standard practice but rarely discussed publicly. Institutional investors learned from this. When questioned about tax practices, don't apologise, explain the logic, show the legality, demonstrate the efficiency. Make critics argue against rational capital allocation rather than against wealth. This isn't about arrogance, it's about framing. The way you present your position determines how others receive it. Present tax minimisation as sneaky or shameful, and that's how it's perceived. Present it as intelligent capital management, and suddenly it's just prudent business practice. Confidence in your position, backed by legal correctness and logical coherence, is a form of power. It shapes narratives, it influences policy, it changes how society views wealth and taxation. The tax code as incentive structure. Let's go deeper into how sophisticated investors actually think about the tax code. They view it as an incentive structure created by government to encourage certain behaviours. Governments want investment in specific sectors: clean energy, affordable housing, small business, research and development, economic development zones. So they create tax incentives for those investments. If you invest in renewable energy, you get tax credits. If you build affordable housing, you get deductions. If you start a business in an opportunity zone, you defer capital gains. These aren't loopholes. They're explicit policy designed to direct private capital toward public priorities. Sophisticated investors study these incentives carefully. They structure investments to capture available benefits. They're not because they're trying to cheat the system, because they're using the system exactly as designed. Packer understood this completely. His businesses took advantage of every legal deduction, credit, and incentive available. But those incentives existed because government wanted to encourage the activities his businesses performed. When Parliament questioned his tax payments, he could have responded, I pay exactly what you intended me to pay when you wrote the tax code. If you don't like the result, change the code. This is the fundamental insight. The tax code isn't just a revenue collection mechanism, it's a policy implementation tool. Government uses tax incentives to encourage desired behaviour. Taking advantage of those incentives isn't circumventing the system. It's responding to the system's explicit signals. Most people don't understand this. They view tax deductions and credits as things you get away with if you're clever. Wealthy investors view them as things government specifically designed to influence behaviour. When you understand that distinction, tax strategy stops being about finding loopholes and starts being about aligning your activities with government incentives. It's not sneaky, it's responsive. Practical application for regular investors. Now, how does this apply to someone who isn't a billionaire? How can regular investors adopt this mindset? First, stop viewing taxes emotionally. Don't feel guilty about minimising tax liability legally. Don't feel proud about paying high taxes. View it as a capital allocation decision. Second, educate yourself about tax-advantaged investment structures, retirement accounts, health savings accounts, 529 education plans, real estate depreciation, long-term capital gains treatment. These aren't loopholes, they're incentives government created to encourage saving, investing, education, and entrepreneurship. Use them. Not apologetically, not shamefully. Use them because they're designed to be used. Third, think about investment decisions through a tax efficiency lens. Two investments might have similar pre-tax returns, but if one generates qualified dividends taxed at 15% and the other generates short-term gains taxed at 37%, the after-tax returns are dramatically different. Sophisticated investors always calculate after-tax returns. That's what matters. Pre-tax return is meaningless if you lose half the taxes. Fourth, consider timing. When you realise gains matters. When you take income matters. When you make deductions matters. Strategic timing can save substantial tax without changing economic substance. Fifth, understand that tax minimisation is a long-term strategy. It compounds over decades. Saving 5% on taxes annually doesn't sound dramatic, but over 40 years at reasonable return assumptions, that 5% difference becomes 30 to 40% more wealth. And this is how the wealthy build generational fortunes. So not through dramatic tax evasion, through consistent, legal, strategic tax efficiency that compounds over time. None of this requires wealth. It requires knowledge and intentionality. Most people pay more tax than necessary because they don't understand the code or don't apply available strategies. That's leaving money on the table. The ethical question. Let's address the ethical concern directly. Is tax minimisation morale? This question assumes taxes are primarily a morale rather than economic issue. Wealthy investors reject that framing. Taxes are how government funds operations. The amount of tax you pay should be determined by law, not by subjective moral judgment about what's fair. If the law says you owe $50,000, you owe $50,000, not $60,000 because you feel generous, not $40,000 because you think government wastes money. Exactly $50,000. The question of what the law should require is a policy question. Citizens should engage with that policy process through voting and advocacy. But once the law is set, following it exactly is proper. Paying more than required doesn't make you ethical, it makes you inefficient. Packer made this argument explicitly. He said he pays whatever tax I'm required to pay under the law, not a penny more, not a penny less. That's the right standard, not penny more, not a penny less. Exact compliance with legal requirements. If society thinks wealthy people should pay more tax, society should change the law, raise rates, eliminate deductions, close specific strategies. That's how democracy works. But expecting individuals to voluntarily pay more than legally required is absurd. No one does that in any other context. You don't pay more than asking price for a house because the seller seems nice. You don't pay more than menu price at a restaurant because you had a good meal. You pay the stated price. In taxes, the stated price is whatever the law requires. Paying that amount isn't stingy, it's accurate. Turning defence into offence. The final insight from Packer's testimony is strategic. He turned a defensive situation into an offensive position. Parliament called him to criticise his tax practices. He turned it into a platform to educate about rational capital allocation. He went from defendant to professor. This is a crucial skill. When questioned about legitimate practices, don't defend apologetically, explain confidently. Frame the conversation on your terms. Packer didn't say, "I'm sorry I pay so little tax," or "I wish I could pay more." He said everyone should minimise tax and anyone who doesn't is irrational. That's offence. He made critics defend why irrational behaviour should be criticised rather than defending why he engages in it. This applies beyond taxes. Anytime you're questioned about legal, rational behaviour that produces optimal outcomes, respond confidently, explain the logic, show the legality. Make critics argue against rationality rather than against you. Institutional investors do this constantly. When activists criticise corporate tax practices, companies don't apologise. They explain that they have fiduciary duties to shareholders, that they follow all laws, that they create jobs and economic value, that governments set tax policy, not corporations. So that's the right response. Confident, clear, logical. The takeaway: taxes as strategic decision. Here's what you need to understand. Taxes aren't a moral test. They're a capital allocation decision. Government sets rules about how much tax you owe under various scenarios. Those rules create incentives for certain behaviours. Following those incentives and minimising tax liability within legal boundaries is rational, proper and intelligent. Sophisticated investors approach taxes strategically. They structure investments for tax efficiency, they time income and deductions optimally. They use available deductions and credits. They plan for long-term compounding of after-tax returns. This isn't about being greedy or unpatriotic. It's about managing capital intelligently. Every dollar saved in taxes is a dollar that can be invested, donated or deployed productively. The system is designed to allow this, and the tax incentives exist because government wants to encourage certain behaviours. Using those incentives isn't circumventing the system. It's responding to it. Most people pay more tax than necessary because they view it emotionally rather than strategically. They don't educate themselves about available strategies. They don't think about timing and structure. They just pay whatever they're told. Wealthy investors think differently. They view taxes as a cost to be managed. They study the code. They implement strategies. They optimize continuously. You can do the same. Regardless of your wealth level, you can approach taxes strategically rather than emotionally. You can learn about tax advantage structures. You can consider timing and efficiency. You can plan for compounding of after-tax returns. This is what Kerry Packer demonstrated in that 1991 testimony. Not that wealthy people cheat the system, but that intelligent people understand the system and use it effectively. The choice is yours. View taxes as an unknowable burden to be endured, or view them as a strategic decision to be managed. One approach leaves money on the table, the other builds wealth over time. Packer chose the latter, and he had the confidence to defend that choice publicly, logically, and effectively. That's the lesson. Not about specific tax strategies, but about mindset. Approach capital allocation decisions, including taxes, rationally rather than emotionally. Understand the rules. Use them effectively. Don't apologise for intelligence. That's how sophisticated investors think, and that's how you should think too.